Welcome to Iron Financial. Look, this is the only explainer where we rigorously audit the structural integrity of the market's biggest players, all to help you forge a much stronger, heavy-duty portfolio. I'm your lead analyst. We really don't care about the PR spin here, and we definitely don't care about those flashy press releases. We strip these companies down to the studs. My focus is purely on the raw numbers, the revenue, the debt, the margins. I want to know unequivocally if the foundation is made of solid concrete or if it's just shifting sand waiting to collapse.
And I'm the market skeptic. I'm right here representing you, the focused learner and the disciplined investor. My job, it's to take a sledgehammer to these earnings reports. Because every single time Wall Street cheers, I'm the one stepping in and asking, is this just hype or is this actually real? Today, we're putting NetEase and their Q1 2026 earnings straight under the microscope. We're going to stress test their entire financial structure to see if it actually holds up under real market pressure. Let's get to work.
Which brings us to the hook of today's audit. Why does NetEase actually matter to your capital right now? Well, we are looking at a macroeconomic environment that is heavily shifting. Inflationary pressures are still aggressively squeezing consumer wallets globally, regulatory frameworks in the tech space are constantly evolving, and everyday investors are desperately looking for safe havens just to park their money. Now, the headline numbers for NetEase's Q1 2026 might look incredibly shiny on the surface, but we need to know the truth. Is this company the high-grade forged steel required to reinforce your portfolio, or is it just painted iron? Are we looking at a structurally sound fortress, or are there hidden, microscopic cracks in the armor that could cause a complete collapse when the next quarter hits?
To understand the stakes, you have to grasp the sheer scale of the corporate structure we're dealing with here. It's staggering. NetEase is an absolute behemoth in the tech and gaming sector. We're talking about a market cap of roughly $74.5 billion. For the first quarter of 2026, they reported net revenues of RMB 30.6 billion, which translates to approximately $4.4 billion US dollars. That right there represents a very solid 6.1% increase year over year. They decisively beat consensus expectations, and honestly, that's a massive signal in a bear-leaning market where so many tech giants are stumbling and missing their marks right now. On the surface, this fortress looks incredibly formidable. But, as anyone in heavy construction knows, a massive, beautiful facade doesn't mean the load-bearing walls are actually equipped to hold the weight. So, we need to step completely past the exterior PR and run a heavy-duty stress test on the internals.
Phase 1. Drill down into the headline numbers. Let's start breaking some rock.
We're going to look straight at those top-line numbers, break them apart, and see exactly what this concrete is made of. For the first quarter of 2026, NetEase pulled in a massive RMB $21.2 billion in total gross profit. To put that in perspective for you, that is roughly $3.1 billion US dollars. Now, in the preceding quarter, Q4 of 2025, that number was sitting lower at RMB 17.7 billion. And in the exact same quarter last year, Q1 2025, it was RMB 18.5 billion. What we have here is a massive year-over-year spike of 14.8%. The profit engine of this company is absolutely roaring right now. This isn't just some incremental growth, we're looking at incredible sequential and year-over-year margin expansion across the board.
Okay, let me stop you right there, because this is exactly where the math needs to be aggressively scrutinized. A 14.8% jump in gross profit, while top-line revenue only grew 6.1%, that translates to a gross profit margin of roughly 69.4%. I'm sorry, but that is a suspiciously high number for a company of this sheer massive size. I demand absolute clarity from the numbers here. Is this margin expansion actually built on true, undeniable revenue growth, or is management just squeezing blood from a stone? Look, in this sector, aggressive operating expense discipline is often a massive red flag. Stagnating companies will routinely fire staff, slash their marketing budgets, and completely halt crucial research and development just to artificially inflate their bottom-line margins and make the quarter look pretty for analysts. And they do all of that while the actual core business rots from the inside out. So is that what's happening here?
Phase 2. We're inspecting the load-bearing pillars, specifically core gaming.
To directly answer your concern about those margins, we have to look straight at the primary load-bearing pillar that's holding this entire $74.5 billion fortress up. The games and related value-added services segment reached RMB 25.7 billion, or about $3.7 billion US dollars. That represents a rock-solid 6.9% year-over-year growth rate. Now here's the heavy metric. An overwhelming 97.5% of that segment's immense weight is carried directly by their online games operations. This is not temporary temporary fluff. This is highly lucrative, incredibly sticky, recurring revenue. And the real catalyst driving this margin expansion you're so skeptical about? It's higher revenues pouring in from their self-developed games. This is absolutely vital to understand. When a company builds and fully owns the intellectual property themselves, they bypass those heavy licensing fees they would normally pay out to third-party studios. They completely control the ecosystem, they keep the lion's share of the profit, and it results in pure operating leverage. That is exactly what's driving those massive margins, not just internal cost cutting. Management specifically pointed to the sustained structural strength of legacy, long-running franchises like Fantasy Westward Journey. This is a genuinely crucial piece of their foundation. Think about this. Fantasy Westward Journey has been running for over 2 decades. It provides incredibly sticky MMORPG revenue with remarkably low player churn. It's the steady, reliable baseline that essentially funds everything else. But they aren't just resting on their legacy laurels either. They are successfully launching high-cadence new content like Where Winds Meet and actively expanding their global footprint with highly anticipated titles like Marvel Rivals. Breaking into the highly competitive Western hero shooter market with a globally recognized IP, that proves their ambition to actually scale cross-market appeal. I'm telling you, this core gaming pillar is as solid as forged steel.
Phase 3. Stress testing the supporting segments.
Fine, I'll admit the core gaming pillar is holding firm, and those IP margins appear to be real. But a fortress of this magnitude simply cannot stand on one single pillar alone. We need to stress test the supporting segments to see if the secondary pillars are actually carrying their weight or if they're buckling under the broader macroeconomic pressure. Well, NetEase Cloud Music showed a very steady, reliable climb, bringing in RMB 2.0 billion for the quarter. That's a 6.6% year-over-year increase. That is a solid, predictable secondary structure right there. Yes, but you have to contrast that with the innovative businesses and others segment, which is visibly bleeding out. They dropped 4.6% year-over-year, falling down to RMB 1.5 billion, and the earnings report specifically notes this quarter-over-quarter decrease was led by direct dips in their e-commerce and advertising businesses. This is exactly what I warned about in the intro. Look, consumer discretionary spend is literally the very first thing to dry up in a tough macroeconomic environment with high inflation. That is a structural weakness. If consumer spending slows down any further globally, that secondary pillar could buckle entirely.
Phase 4. Finding the real cracks in the armor, the UDAW segment. All right, this is where I am finding serious structural cracks in the financial reporting, and anyone allocating capital here needs to pay very, very close attention. Sure, the total net revenue for the UDAW educational subsidiary was RMB 1.3 billion, which is a minor 3.8% increase overall. And yes, digital learning services managed to grow 4.2% to roughly RMB 627.5 million. But while those learning services grew slightly, the smart devices revenue completely collapsed. I mean, it plummeted by an absolutely staggering 42.6%, falling all the way down to just RMB 109.4 million. They cite a severe decline in demand for smart learning devices, things like their translation pens and digital dictionaries. Hardware is a notoriously brutal business when everyday consumers tighten their belts. So I demand to know, does this localized bleeding threaten to infect the broader foundation of the entire company? And trust me, it gets worse. Not only did the actual sales volume completely collapse, but the UDAW smart devices gross margin plummeted from 52.3% in Q1 of last year all the way down to a painful 39.9% this quarter. The report explicitly blames an increased bill of materials cost. They are getting squeezed heavily on supply chain friction and core component costs, making the few devices they actually do sell significantly less profitable. Look, I definitely hear your concern, but let me defend the overall structural integrity here. Yes, the margin compression from higher material costs requires some heavy lifting to fix. However, management is demonstrating strict, very mature fiscal discipline. They are actively prioritizing unit profitability over sheer volume. They are deliberately refusing to sell hardware at a loss just to pump up top-line vanity metrics to impress Wall Street analysts. That shows a highly disciplined approach to capital allocation. They're protecting the core foundation, even when a specific, localized hardware segment is temporarily under severe pressure.
And let me definitively prove that the overall corporate structure remains incredibly sound by analyzing the entire financial load across the whole company. Look at the total cost of revenues. It actually dropped by 8.7%, going from RMB 10.3 billion down to RMB 9.4 billion. Why? Because they significantly lowered their platform revenue sharing costs. In the gaming and tech industry, negotiating better distribution rates or successfully shifting users over to proprietary launchers literally saves billions. Now, it is true that total operating expenses climbed slightly by 6.5%, up to RMB 8.6 billion. But that was primarily due to targeted marketing and necessary administrative investments. Because they managed the core cost of goods so effectively through those platform savings, the ultimate non-GAAP net income still managed to grow slightly by 0.9% to a massive RMB 11.3 billion. The overarching foundation is holding the load beautifully, plain and simple.
Okay, the foundation might be holding the Q1 load right now, today, but the stock market is a forward-looking mechanism. It doesn't care what you did yesterday. I'm challenging the near-term durability of this stock right now. What happens when the current momentum hits a complete brick wall in Q2? The upcoming second quarter is notoriously a lull period for the entire gaming industry. School is still in session, there are fewer major holidays, and player engagement just naturally dips. Furthermore, NetEase is facing an incredibly tough year-over-year comparison base because Q2 of last year was an absolute monster quarter for them. If you buy into this company right now, there is a very real mathematical risk that your capital is going to sit entirely flat, essentially dead money, doing absolutely no work for you for months on end.
Phase 5. The final verdict. Is this an opportunity or a trap?
This brings us to our final structural integrity report. We need to weigh the foundation's raw numerical strength against the shifting sands of the macroeconomic environment. Before we deliver the final call, consider the absolute ultimate safety net for any investor: $24.3 billion. As of March 31, 2026, NetEase holds $24.3 billion in total net cash. That's cash, cash equivalents, time deposits, and short-term investments, completely minus their loans. In an era of high interest rates and constant macro shocks, this is the ultimate defense. If the global economic environment cracks, if the shifting sands pull over-leveraged tech companies under, NetEase has a multi-billion-dollar concrete reinforced bunker to easily weather the storm. This fortress is heavily, heavily fortified.
And they aren't just sitting in that bunker hoarding cash, they are actively pouring it directly back into their own foundation. Under their current share repurchase program, they have already bought back 23.2 million American depository shares for approximately $2.1 billion. By actively buying their own concrete and retiring those shares, they are mechanically reducing the overall float. Shrinking the number of available shares directly boosts the proportional ownership and value of every single remaining share you hold. Management firmly believes the stock is undervalued, and they're executing a total masterclass in returning massive amounts of capital directly to the shareholders, all while continuing to pay out a very healthy quarterly dividend.
All right, I will concede this vital point. Trading at a roughly 12x PE ratio, the stock undeniably looks cheap on paper. The value proposition is absolutely there. But I am issuing a direct warning to the listeners. This is strictly a defensive play for your portfolio. You are not going to see a rapid, vertical, highly aggressive breakout tomorrow morning. You must have the discipline and the patience to sit through the summer beta tests. Games like Marvel Rivals and Where Winds Meet are just testing the scaffolding right now. Real, actionable revenue recognition from those properties will not hit the balance sheet until their late Q4 releases actually act as a catalyst for the stock price. If you do not have a rigorous 6 to 12-month time horizon, this stock will brutally test your patience.
So we leave you with this provocative question for your own capital allocation. When you look at your portfolio, are you building your positions on stone foundations or shifting sand? The heavy data from this Q1 2026 audit shows undeniable structural integrity. They have pure operating leverage from self-developed IP, massive multi-billion-dollar cash reserves, and high-margin core gaming growth that just refuses to quit. It is a financial fortress. But, as an investor, you must relentlessly protect your downside. You need to size your position correctly, respect the reality of the upcoming Q2 gaming lull, and recognize the severe macroeconomic pressure crushing their secondary hardware and e-commerce segments. You have the raw audit data now. It is entirely up to you to decide if NetEase is the long-term, high-grade steel opportunity you need or just a value trap for impatient capital. Thank you for joining us for this explainer. Keep rigorously forging a stronger portfolio, and we will see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.